When bullish market momentum abruptly turns bearish, or the opposite occurs, it signals a possible market reversal. Known as a CSD, change in state of delivery. This transition offers a valuable opportunity for traders, particularly those aiming for setups with strong risk-to-reward ratios. In this video, we'll break down what a change in state of delivery, CSD, means, the essential rules for applying it correctly on charts, and how this concept can align with other smart money principles to identify high-quality trade opportunities. If this topic interests you, make sure to hit the like button. And if you're new here, don't forget to subscribe and turn on the notifications. I'll see you right after the intro and disclaimer. So, what exactly is a change in state of delivery, CISD? It's a reversal setup where price momentum suddenly shifts direction. In this example, you can clearly observe a bullish trend. These three candles indicate recent bullish momentum, breaking the previous market structure. This is also referred to as the recent buy-side delivery. We mark the body of the first candle as the origin point of this upward movement. The structure remains clearly bullish. After a minor correction, we expect the price to continue rising. However, if the price suddenly drops and closes below the demand zone, meaning the entire bullish impulse has been invalidated, this is called a change in state of delivery. What does this imply in terms of price action? First, it shows that the breakout was actually a fake out, engineered to capture liquidity resting above the market structure. The buy-side delivery activated buy-side liquidity, followed by a bearish reversal completing the market maker model. When the price breaks below the demand zone, it confirms that buyers could not maintain their long positions and sellers have taken control. This reversal pattern signals a downward transition in the market. Now, the question is, how do we apply this concept in trading? At this stage, our market bias has turned bearish. This means we will now focus solely on short setups. Once we identify a break and close below the origin of the buy-side delivery, we understand that the previous support level has now flipped into resistance. This structural shift becomes a key signal for us. When price revisits this level, when it pulls back to the resistance zone, it offers the best opportunity to take a short position. This is because the zone that once acted as support now functions as resistance. Hence, the probability of price rejection and a bearish continuation increases significantly. Entering a short trade here allows us to take advantage of the bearish momentum, forming a high-quality trade setup with an excellent risk-to-reward ratio. The most crucial factor is patience. Wait for the price to retest the resistance zone before entering a trade. Doing so enhances the chances of capturing a strong bearish move while minimizing risk. This same principle applies in bearish conditions as well. CISD occurs when price momentum suddenly reverses and breaks above the recent sell-side delivery after sweeping liquidity below a significant low. This indicates that sellers have lost control, and the market is likely preparing for a bullish reversal. When price retraces to the previous supply zone, it presents a high probability long entry. Both concepts may appear similar, but there are distinct differences between a change in state of delivery and a change of character. A change of character happens when price breaks a clear market structure, confirming an overall trend reversal. In contrast, a change in state of delivery focuses primarily on a sudden momentum flip to the opposite side, often signaling a potential structure shift even before the change of character appears. However, it's essential to remember, not every CISD pattern on the chart leads to a profitable setup, especially if it forms randomly without structure or context. To trade CISD effectively, it must align with broader market factors. Through backtesting, we've found that CISD patterns work best under specific conditions. To validate a proper CISD and capture quality trades, it's crucial to follow certain rules. Let's now go over the conditions that enhance the reliability of a CISD pattern. Rule number 1. Rejection from a higher time frame zone. As discussed earlier, CISD is a reversal-based price action concept and works best when price first reacts to a higher time frame zone, such as the 4-hour, daily, or weekly chart. Levels identified on higher time frames carry stronger influence over market direction. When price taps these zones and a CISD pattern forms, it signals a reversal from a critical region. increasing the reliability of the setup. If higher time frame confluence is missing, CISD may appear in an irrelevant area, lowering the chances of a significant shift and reducing trade success probability. Rule number 2. Sweep of a liquidity pool. A strong CISD setup often appears after the market sweeps liquidity on one side. Liquidity pools usually form near equal highs or equal lows where traders place stop-loss orders. When the price takes out these levels, those stops get triggered, activating liquidity and creating the perfect setup for a reversal. Once liquidity is cleared, price tends to move in the opposite direction, setting the stage for a valid CISD formation. This action shows that the market has accumulated enough momentum to reverse, making the pattern more trustworthy. Rule number 3. Volume and confirmation. A valid CISD setup should be accompanied by a noticeable rise in trading volume during the momentum shift. Increased volume shows that more participants are involved, reinforcing the move and confirming the strength of the setup. Entering a trade solely based on CISD without volume confirmation can be risky, as it often represents a weak and unsupported move. Rising volume can also be spotted through fair value gaps, areas on the chart where price moves aggressively, leaving imbalances due to heavy buying or selling pressure. These gaps visually represent increased activity and volume. When a CISD forms alongside a fair value gap, it's a clear indication that institutional or large players are driving the move, adding credibility to the setup. A retracement into a fair value gap often provides a high probability entry opportunity since the market tends to fill these imbalances before continuing its directional move. By combining CISD, fair value gaps, and volume confirmation, you can significantly improve trade accuracy and minimize risk. Rule number 4. Break and retest of the origin point. Once the price breaks the origin level, it's important to observe the retest. This pullback validates that the previous level has officially flipped, acting as resistance in a bearish setup or support in a bullish one. Entering a position on this retest enhances your risk-to-reward ratio and confirms the legitimacy of the reversal. By following these rules, identifying CISD at key higher time frame levels, confirming with volume and fair value gaps, and waiting for retests, you improve your chances of spotting high-quality setups with strong profit potential. Now that we've covered what the CISD pattern is and how to properly apply its rules on charts, let's move on to some real market examples to see how these concepts play out in live trading conditions. We now have a 15-minute chart of the euro-dollar. Here, we can observe a bearish market structure where price recently broke a key level that had acted as support multiple times in the past. If we examine the latest impulsive move that caused this break, we notice strong bearish momentum, highlighted by the creation of a fair value gap. This indicates that sellers successfully broke the support and took control of the market. From a price action standpoint, if price pulls back to the former support, which has now turned into resistance, there is a chance for rejection, potentially leading to a continuation of the downward move. However, the market then experienced a strong bullish impulse, forming several FVGs and breaking above the resistance area. This sudden momentum shift signals that the state of delivery has changed, suggesting a possible reversal. Moreover, this breakout could be a fake-out designed to target liquidity below the current equal lows. So, how should we approach this scenario? Following our trading plan, we mark the opening of the candle that triggered the bearish order flow as a key level. When price returns to this level, we expect a rejection, presenting a potential long entry. Before taking the trade, it's essential to zoom out to a higher time frame, such as the 4-hour chart, to better understand the overall market context and confirm the bigger picture. Zooming out to the 4-hour chart, we can see that price has reached a significant level. Even a small reaction at a higher time frame zone can indicate a major trend shift. This observation aligns with the move on the 15-minute chart. Additionally, higher time frame analysis validates that the upward movement seen on the 15-minute chart is legitimate. Our higher time frame target may lie near this market structure level, just ahead of the current price. Returning to the 15-minute chart, our trading plan allows us to set a buy limit slightly above the origin point, aiming for a 1-to-2 risk-to-reward ratio. The stop loss will be positioned here to protect against unexpected market swings. This approach enables us to combine the CISD pattern with multi-time frame analysis and other price action strategies to enter high-quality trades. However, regardless of how promising a setup appears, the market can always behave unpredictably. That's why having a strong risk management plan is critical. It protects your capital while allowing you to take advantage of profitable moves when the market aligns with your analysis. Here, in our second example on the 15-minute chart, this zone has acted as support multiple times. Traders who took long positions likely placed their stop losses just below this support area. This means a significant amount of liquidity is pulled beneath this level. Now, let's observe what happens next. Price breaks through this zone with strong bearish momentum. The fair value gap formed during this move suggests that the barrier has been breached, signaling further downside pressure. However, price quickly returns to the range, creating another bullish FVG. This scenario illustrates a complete change in state of delivery, shifting from bearish to bullish. It indicates that the breakout was likely a market maker move, engineered to target liquidity below this zone. With the sell side liquidity swept, smart money now has the opportunity to go long, aiming for buy side liquidity above. With the market direction identified, the next question is, where should buy limits be placed? According to our trading plan, the start of the last downtrend can serve as support and provide a potential long entry point. Additionally, the fair value gap formed during the pullback can act as an extra support zone. Regardless of the chosen entry, a stop loss should be positioned below the FVG for protection. The recent high will serve as the take profit target. This example perfectly demonstrates how to spot a change in state of delivery on a chart and how it differs from a change of character. A change of character occurs when price breaks a significant market structure, signaling a shift in overall market direction. This change can be gradual or abrupt, depending on momentum, but the key factor is the breach of an important structural level, indicating buyers or sellers taking control. In contrast, a change in state of delivery focuses on rapid momentum shifts where price flips from bearish to bullish, or vice versa. CISD is identified by a swift change in price direction and confirmed when price breaks the origin of the prior movement. CISD often provides early indications of a potential reversal, sometimes appearing before larger market structure confirms it. Combining CISD with liquidity concepts, such as liquidity sweeps and fair value gaps, further improves trade quality. For instance, CISD occurs when liquidity is swept from one side of the market, signaling sufficient accumulation for a reversal and increasing trade reliability. This method allows traders to enter positions with greater confidence, aligning entries with momentum shifts and key liquidity zones. By understanding both CISD and change of character, and using them alongside liquidity analysis, you can refine your strategy and improve the chances of entering high-quality trades with favorable risk-to-reward ratios. So, friends, don't forget to backtest this approach and see firsthand how it performs. That's it, traders. Thanks for watching this video. Ideas alone don't change your life, taking action does. If you found value in this video, make sure to hit that like button. And if you're new to the channel, don't forget to subscribe and turn on the notification bell so you never miss what's next. Don't overthink, take action, learn from it, adjust, and keep moving forward. That's how real progress is made. Stay consistent, stay disciplined, and I'll catch you in the next video.